So you've got your loan at least in mind, your down payment made, you like to think you're done figuring out how to pay for things, all that different fun stuff, but actually you still have the bank presumably to deal with. Usually loans are handled through a bank for a mortgage, not always, I suppose.
You know who owns the land, the Shawnee Land and Cattle Company.
And who's the Shawnee Land and Cattle Company?
It ain't nobody, it's a company.
They got a president, ain't they? They got somebody who knows what a shotgun's for, ain't they?
Where when you're setting this up, part of the process may involve paying what are called points to the lender, where you have what are called discount points in one hand, where these are basically percentage values of the total mortgage amount, the total loan amount that you can pay up front to try and get a discount on things like your mortgage rate, where it's said that 1 percentage point given gets you about 0.25% off on a fixed rate mortgage. Basically, you can use these discount points as a negotiation tool to try and make sure you get the best version of your payment plan settled up front. But there are also fees with points that sometimes have to be paid as part of the loan. These are what are called origination points, where origination is the process of setting up a mortgage. So essentially these are the commission fees for the bank for helping set up the loan, for the paperwork, for the man hours that go into that. That's kind of their fee there, which wouldn't affect your mortgage payments in any way. You just have to pay those. A lot of banks will require 1 or 2 points to be thrown in there in that way. And along this process, you'll also get something called a truth in lending disclosure statement, which basically gives all of the financial details of your loan. Things like the rate, what kind of rate it is, the payment plan, the value of the mortgage, and really anything else that might need to be put in there to make sure you know where your money's going and how long it is going to be going. And this was put into place as a result of the Home Equity Loan Consumer Protection Act of 1988. Like I said, a lot of the way that the housing market works in America is the result of specific litigation as a result of things that happened to people along the way. Where, once you have that in mind, once you have your mortgage set up, your payments all lined up for what may be the rest of your life, some additional money may be put into what's called an escrow account, where escrow accounts are used to manage things like property taxes and insurance, and some banks will require you set one up as part of the process, where escrow accounts usually cost a little bit of money to get set up, but they can help you out with managing the costs because they sort of automate them, because you know you're just tossing an extra, however much it happens to be, into your monthly payment that gets filtered into that separate account to manage those extra costs, where also they're not required, but sometimes a bank will still give better rates if you set up an escrow account with them along the way. They're not going to complain about making sure that you are handling these types of things as well. But, you know, having something like this set up, it kind of hides the costs, and you might be able to comparison shop for better rates on things like homeowners insurance instead of just saying, I'm going to throw 1, 2, 3, 4, I don't know how much homeowners insurance costs because I don't own my apartment, but some amount of money into that account to make this work. It's really a matter of the situation, whether you have to get one or you want to get one. It varies from bank to bank, from house to house, from mortgage to mortgage. Finally, though, once all those things are set up, once you know where your money's going, how much it goes into escrow, how much it went into points, you can actually talk about your monthly payment, which, like I said, follows the exact same formula as it did when we were talking about cars. Where yes, usually you get these payments in terms of a monthly value. It doesn't necessarily have to be, but that's what's most common. So let's get a quick example here talking about car payments.